Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Hello and welcome to Different Makes a Difference. I'm Stephen Boland. We often talk about stocks on this podcast, but there's an asset class that we also focus on a lot at Odlum Brown. It's an important part of many people's portfolios, and that's fixed income. So today we're going to provide some background on what fixed income investing is and how it can play a role in your portfolio. To do that, we're joined by Dave Pearson. He's Vice President, Trading and Syndication, and he also leads our fixed income strategy. Dave is new to the podcast, but he has been with Odlum Brown for more than 30 years. Thanks for joining us, Dave.
Nice to be here, Steve.
So, Dave, can you start by telling us a little bit more about yourself? How long have you been involved in fixed income and what first got you into it?
Sure. My first influence came from my dad. He was a bond salesman at Cloud Young Weir, which in the 80s was bought by Bank of Nova Scotia and ultimately became Scotia McLeod. So that gave me my first exposure to the business, but it didn't really explicitly drive me into getting involved. After university, I got a job at Odlum Brown in the client services department. I worked there for about 6 months, and then an opportunity came up as a money market trader. I was lucky enough to get that job, traded money market for a while, progressed into bond trading, and now 30 years on, I'm still trading some bonds and involved in some strategy.
So, what is fixed income investing? What exactly are you getting when you buy fixed income?
Fixed income investing and bond investing, those terms can be used interchangeably. I'll refer to bonds right now in answering this question. When you buy a bond, you are essentially lending money to the issuer of that bond. The issuer might be any government or corporation. When you do buy a bond, you're buying a bond with a predetermined maturity date and a predetermined interest rate, or otherwise known as a coupon. As an investor and a holder of that bond, throughout the life of the bond, you'll be periodically paid interest. And then upon the maturity date, you will be repaid the full principal value of your investment. These predetermined term to maturity and interest rate is why the term fixed income.
Makes sense. So I hear different terms when describing different types of fixed income. I'm thinking in particular bonds, money market, and GICs. What are the differences in these instruments?
Money market is essentially the very short end of the bond market or the fixed income market. It's 18 months or less to maturity. These money market instruments are issued by governments, corporations, same as bonds, those entities requiring short-term cash. And the investors in money market instruments are using them for cash management purposes and short-term investing. Unlike most bonds, money market instruments are not issued with a predetermined interest rate. Rather, they're normally issued at a discount to their par value. And when they mature at par, the difference between those two values is returned to the investor. One example, a common example of a money market instrument would be a Government of Canada Treasury bill. GICs, or guaranteed investment certificates, are issued by banks, credit unions, and other deposit-taking institutions. They're like bonds in that they have a predetermined maturity date and a predetermined rate of interest. But unlike bonds, they are not saleable or redeemable by the holder prior to maturity. The buyer of a GIC is locked in for the term of that investment. GICs act as fixed-term deposits and can typically be bought up with maturities after 5 years. Bonds, on the other hand, are issued with any range of maturity date, from very short-term out to 30 years or longer. And there is an active secondary market for bonds, where any bondholder can buy or sell bonds at any time prior to the maturity.
Okay, well, that's some great background there. Why is it important to have fixed income in a portfolio?
Well, firstly, by definition, they are income securities. They provide income to the investor, and that can be important for, say, a retiree who's relying on their investment portfolio to fund their retirement. A conservative bond portfolio can also add ballast and diversification to an overall portfolio, which is important. And bonds often react differently to economic and geopolitical events than equities will. That can provide downside protection to a portfolio, and it can also smooth investment returns over market cycles.
Okay, so a very important part of portfolios. What percentage of an individual's portfolio should be invested in fixed income?
Well, that depends on the individual circumstances, but really, the rule of thumb is to use an investor's age as a percentage of the fixed income component of a portfolio. As an example, a 60-year-old should have roughly 60% of their portfolio in fixed income. Now, other factors will play into that, things like net wealth of that individual, income needs at retirement, their investment objectives, their investment horizons, etc. But in general, one's allocation to fixed income should increase with age.
Okay, so good rule of thumb there, but ultimately varies by the individual, as do many things in investing. A term I often hear at Odlum Brown is the concept of bond laddering. What exactly is a bond ladder?
A bond ladder is a tried and tested approach to building a bond portfolio that addresses many of the risks in fixed income investing and can take away a lot of the guesswork as well. Visualize a ladder where each rung of the ladder represents a year in the future. A 5-year bond ladder would consist of 5 different bonds, each maturing in 1-year intervals out that ladder. After 1 year, first bond on that 1-year bond matures, and the proceeds of that bond would then be reinvested into a new 5-year bond, and you continue that process year after year. This approach allows you to diversify your holdings by credit, diversify by term to maturity, and therefore you're mitigating a number of the risks, including credit risk, reinvestment risk, and interest rate risk.
And we were talking about before this about, you just gave an example of a 1 to 5 year ladder. You can have all sorts of different ladders. You can maybe tell us a little bit about that. I found some of the concepts, micro laddering or
Sure.
getting
Yeah,
different types of
depending on
income
the goals of the investor, you could have a very short-term ladder of a few years with maturities monthly or semi-annually. You could extend the ultimate end date of that ladder out further into the future. A 10-year ladder would not be uncommon at all. So there's lots of variations. It's just a construct that provides some structure to your.
Right. And again, you determine exactly what to build based on the individual's needs.
Yeah.
But you tend to recommend keeping maturities shorter. So you're talking ladders typically with 1 to 5 year maturities as opposed to, for example, 20 to 30 year maturities. Can you just expand on why keep maturities shorter?
Well, a well-constructed bond portfolio can add some stability to an overall investment portfolio. But even with that, bond prices themselves can be volatile. Bond prices move inversely with interest rates. So anytime interest rates are rising, bond prices will be falling. And longer-term bonds are more sensitive to changes in bond prices. So longer-term bonds can be quite price volatile. Because of the volatility in long-term bonds, an investor, unless an investor has a long-term liability or a need for those funds, investing in long-term bonds can be quite an aggressive approach. Our approach to fixed income is more conservative. We strive to preserve capital and earn a attractive rate of return on the way through. Portfolio shorter-term bonds accomplishes that and stays within the investment objectives of many of our clients.
Okay, that makes sense. There are a lot of different issuers of bonds. You referred to earlier the fact that governments issue bonds, a whole host of different companies issue bonds. I've seen banks and pipelines, airports and toll roads and food companies, the list goes on. What do you look for in the specific issuers that you recommend?
Well, we like to focus on quality for one. Government bonds satisfies that requirement. In terms of corporate bonds, we mainly look at larger cap companies, companies with strong balance sheets, with reliable recurring cash flows that can be used to service that debt that they're incurring when they issue bonds. Banks, pipelines, utilities fit into that for us. As well, we also like to look at the bonds issued by companies that are whose equities are followed by our research department. Liquidity is also a key consideration for us. Liquidity, I mean the ease with which a bond can be bought or sold in the marketplace. Liquidity varies between bond issuers and bond issues and is normally reflected in the bid-offer spread. At times of economic or geopolitical stress, liquidity can be compromised. And we want to make sure and do our best to make sure that our clients are able to sell their bonds if circumstances dictate. We also look at relative prices of different bonds in the market to assess whether an investor is being fairly compensated for that extra risk they might take in a lower quality bond. A bond that of lower quality or less liquidity should pay a higher yield than a higher quality, more liquid bond. And we want to make sure that that is the case. In today's market, that extra yield has shrunk, and that makes higher quality bonds, even though they might yield a little bit less than a lower quality bond, relatively more attractive. The Odlum Brown model portfolio represents our current approach to fixed income investing. It's a hypothetical portfolio that made up of government and high quality corporate bonds ranging in maturity from the very short term out to just under 5 years. We track performance of the model monthly and compare it to the FTSE Bond Universe Index.
Okay. I'm not going to ask you how that model is done because I know you're a pretty modest guy, but I did look it up before I came here today, and the model has done better than the benchmark in each of the last 4 years. So that's a really nice accomplishment. I want to end by asking, and I know I had a similar question earlier, and you've kind of made reference to this throughout, but why not simply go for the highest yield in fixed income?
An investor seeking income in their investment can naturally be drawn to the higher yielding opportunities, but that higher yield invariably comes with more risk. And that risk may come in the form of price volatility, price impairment, or in drastic cases, default by the issuer of that bond. There can be a time and a place to take on some exposure to high yield if one has the risk tolerance and risk capacity to do so. But we believe fixed income shouldn't keep you up at night. We think quality is paramount for most investors, and therefore we steer our clients towards higher quality issues.
Okay, well, that's great. Well, thanks, Dave, for that. I think that's a good place to end it today. A message that really came through for me is that you're very focused on not taking excessive risk with a bond portfolio. That can mean sacrificing a little bit of yield, but it can also keep you out of trouble. You're advising that fixed income be kept to high quality holdings so that it can provide the stability, predictability, and ultimately the income that it's intended to deliver. So thank you all for listening. We hope your year is off to a good start, and we look forward to talking again soon.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.